Let's jump right in. If you've been watching the markets at all lately, you already know that Dell Technologies is hands down one of the most incredible stories of 2026. I mean, we are literally watching a legacy PC maker completely reinvent itself from the ground up into an absolute AI powerhouse. And believe me, the market has definitely noticed. Their stock has more than tripled year to date. So today we're going to break down exactly how they're pulling off this massive pivot and what it actually means for you.
Okay, let's dive into this because with a stock that skyrocketed this fast, the ultimate question on every investor's mind is super simple. Is it still a buy? Right? To figure that out, we need to look past the flashy headlines. We're going to let the hard numbers, the actual growth drivers, and yeah, the very real risks tell the true story of where the stock stands today. Here's our roadmap for this explainer. 1. We'll cover the AI server boom. 2. Dell's winning strategy. 3. Valuing the AI powerhouse. 4. Navigating the risks. And 5. We'll wrap up with the final verdict. Let's get to it. Section 1. The AI server boom. And wow, was it a record-breaking quarter? The numbers here are just staggering. In Q1 alone, Dell's Infrastructure Solutions Group posted a record $29 billion in revenue. And that was driven by a mind-blowing 757% year-over-year surge in AI-optimized server demand. And this perfectly illustrates the flip. For decades, when you heard Dell, you thought personal computers. But AI server sales just hit $16.1 billion, which officially eclipses their entire traditional PC business at $14.6 billion. It's a complete, fundamental shift in their core identity. But, maybe the most telling metric of all is this one, $51.3 billion. That massive number is Dell's record AI order backlog. To put that into perspective, that is roughly the GDP of a small country. And these are servers that are already sold. Dell is literally racing against the clock to build and ship them because demand is just massively outpacing supply right now. Because of that giant backlog, management went ahead and raised their full-year AI revenue target to roughly $60 billion. They bumped guidance up by $10 billion just 90 days into the year. It's wild. Plus, this isn't just a handful of massive tech giants buying up everything. Dell's AI customer base grew by 50% in just 6 months, crossing 5,000 unique customers globally, from massive enterprises to sovereign entities. Moving on to Section 2, Dell's winning strategy, and how exactly they are building their competitive moat. So, why is Dell winning? Well, their success really comes down to 4 main pillars. First up, deep strategic partnerships with both NVIDIA and AMD, which gives them a huge leg up in securing those super high-demand GPUs. Second is their AI factory solutions. Third is their high-margin, sticky storage, think PowerStore and PowerScale. And fourth, they have incredibly strict, self-funded financial discipline. So, the crucial point here is that second pillar, the AI factory. Dell isn't just shipping out empty metal boxes and wishing companies the best of luck. No, they're providing a complete, end-to-end enterprise solution. They combine the compute power, the massive data storage AI needs, the networking, and the software all into one tightly integrated package. It streamlines everything for the customer, and honestly, it keeps them walked right into that highly profitable Dell ecosystem. And when we talk about that fourth pillar, financial discipline, the contrast with competitors is pretty eye-opening. Dell is funding this massive, sprawling expansion entirely internally from its own cash flow. Compare that to one of their main rivals, Supermicro, who recently had to go out and raise $7 billion, severely diluting their shareholders' equity in the process. For anyone looking to invest, Dell's self-funded approach is just a much safer, much more disciplined bet. All right, Section 3, valuing the AI powerhouse. Let's ground some of this hype. Now, what's really interesting here is that with the stock up over 190% this year, you'd probably assume the ship has completely sailed, right? But Dell's valuation actually remains surprisingly reasonable. Their forward PE ratio is sitting right between 23 and 25. Sure, that's high if we were talking about the old legacy Dell, but it's well below the current industry average of roughly 30. And on top of that, their PG ratio, which looks at price relative to expected earnings growth, is sitting below 1.0. That's a classic hallmark of an undervalued stock. So how on earth does the valuation stay that digestible when the stock has literally tripled? Well, it's because analysts are projecting Dell's net income to surge by an explosive 80% going into fiscal 2027. When your earnings are growing at that kind of warp speed, it makes those current valuation multiples incredibly easy for the market to swallow. That brings us to Section 4, navigating the risks. Time for a reality check. Because look, no company is totally invincible. There are three major bottlenecks that pose real threats to Dell's current trajectory. First, a serious component crunch. Second, margin pressure, because believe it or not, these super expensive AI servers actually have lower profit margins than Dell's traditional enterprise stuff. Management is heavily betting that customers will buy enough of those high-margin storage solutions to balance things out, but it's a tightrope walk for sure. And third, obviously, is fierce competition.
Actually, let's zoom in on that first risk. Dell's own management put it perfectly bluntly, saying there is no capacity issue. It's parts. The biggest bottleneck right now is not demand. It is purely the supply chain. Soaring memory chip prices are putting some very real, tangible pressure on their overall profitability. Simply put, Dell can only build these servers as fast as the global supply chain allows them to. And you better believe the competition is not sleeping through this. Hewlett-Packard Enterprise recently reported $1.8 billion in their own AI systems orders. Rivals are getting aggressive, and they are hunting for the exact same enterprise AI infrastructure dollars that Dell relies on to fuel this growth. Finally, Section 5, the final verdict. Are they firing on all cylinders? Taking everything we've just unpacked into account, how do we objectively look at Dell today? Well, the bull case points to that explosive 80% earnings growth, their exceptional visibility thanks to that massive $51.3 billion backlog, and a really disciplined, self-funded strategy. But the bear case argues that the stock is currently priced for absolute perfection. Any sort of slip-up, whether it's from severe component shortages or shrinking profit margins, could instantly trigger a massive market correction. So what does this all mean for you? I'll leave you with this final, provocative thought as you continue your own research. Is Dell currently priced for perfection, just waiting to punish investors for any tiny misstep? Or is this actually still the ultimate undervalued AI infrastructure play for the long haul? I hope this explainer gave you some solid clarity on a truly fascinating story. Thank you so much for joining us, and keep learning.